Should I buy life insurance? This is one of the common questions I get, and in this video, I'm going to point out some factors you should consider when you're trying to make a decision. Hey, welcome back. My name is Gilbert with ZA Financial. We are all about transparency and education when it comes to life insurance and financial products in general. We believe that when you have a good understanding of financial products before you jump into it, it helps reduce buyer's remorse and it allows you to use the product in the best possible way. This is why we focus on transparency and education. You should never ever feel rushed into getting any product without fully understanding it. Now, before we dive deeper into the topic, let's start by understanding what life insurance actually is. Life insurance is a contract between you and an insurance company. In exchange for regular premium payments, the insurance company provides a death benefit to your beneficiaries when you pass away. In addition to the death benefit, certain types of life insurance policies provide other benefits such as cash accumulation and living benefits. Living benefits in life insurance allows you to accelerate a portion of the death benefit if you experience certain qualifying conditions, such as when you become critically ill, chronically ill, or cognitively impaired. Now, our focus in this video is to look at life insurance in general. So we're not going to cover the differences among the various types. I'm going to have a separate video for that, and it's going to be in the description below. Now, let's look at some of the factors to consider when deciding whether you should get a life insurance policy or not. First one is financial protection. If you have someone in your life who depends on your income to meet their living expenses, I'm talking about a spouse, a child, or even your parents, then life insurance can provide the financial protection needed should you pass away unexpectedly. Life insurance serves as a safety net, stepping in to replace your income and secure your family's financial future. Now, while it cannot erase the emotional pain and heartache, it does provide them with a sense of stability during a difficult time. It provides your family with time and peace of mind, enabling them to focus on the healing process without the added stress of financial uncertainty. So if you have someone who relies on your income to meet their daily needs, then getting life insurance is a profound act of love and responsibility. The second point is debt, liabilities, and other expenses. One thing I often hear is, I'm not married, I don't have kids, so I don't need life insurance. Well, even if you are not married or don't have kids, there's still a financial expense that will be incurred should you pass away. And the last thing you would want is to burden your family with unexpected expenses in a very difficult time. If you have significant debts like a mortgage, car loan, or even student loans, life insurance can be a real lifesaver. It acts as a safety net, ensuring that those liabilities are covered so your loved ones won't be left to deal with those financial burdens if something were to happen to you. This becomes even more crucial in certain situations. Let's say you have co-signed loans, okay? In that case, the responsibility for those debts doesn't solely fall on you. It's a shared responsibility, which means your loved ones could end up bearing the burdens if you are not around. And it doesn't stop there. If you reside in a community property state where spouses share the responsibility for certain marital debts, then the implications are even more significant. In such cases, your debt becomes your spouse's responsibility, and life insurance proceeds can take away the financial stress. So even if you don't have a spouse or children, it's essential to consider the potential expenses and debts that may arise when you pass away. The next point is tax diversification. As the national debt keeps growing, it's becoming increasingly likely that the government will have to start paying off the debt. And you know what that means? higher taxes for all of us. That is why it is a smart move to have some of your money in a safe and secure place that won't be affected by changes in tax laws and brackets. You may need some form of tax-free vehicles in your portfolio. So what are the options? Well, we have Roth IRA, municipal bonds, and permanent life insurance. Roth IRA can be a great choice if you earn less than $153,000 as a single person or less than $228,000 as a married couple in the year 2023. With the Roth IRA, you contribute after tax dollars, and the best part is that your withdrawals in the future are completely tax-free. It's definitely something you should think about if you are comfortable with investing in the market. Just remember there is a contribution limit, which is $6,500 for the year 2023. Now the next is municipal bonds. With municipal bonds, the interest income is typically tax exempt at the federal level and sometimes even at the state and local levels. Usually if it's invested in your state, then it's tax-free. However, it's important to keep in mind that when determining how much of your Social Security benefit is taxable, income from municipal bonds is included in your modified adjusted gross income. The last option we have is permanent life insurance. This type of insurance also provides some tax advantages. Typically, growth within the policy is tax deferred, meaning you won't owe taxes on the gains until you withdraw them, although withdrawal up to the cost basis is tax-free. What this means is that if, for instance, your total contributions into your policies or your premiums that you've paid into the policy is $100,000, then you can withdraw up to $100,000 tax-free. Through loans, you can even access the growth tax-free because loans are not taxed. Plus, the death benefit your loved ones receive is usually income tax-free. Now, it's worth noting that although the IRS doesn't impose any contribution limits for life insurance, the insurance company will determine how much you qualify for based on your financial situation. With life insurance, you will have to qualify medically. Therefore, it is generally a good idea to think about your long-term financial strategy and apply as early as possible if life insurance makes sense. Imagine that you will need $80,000 a year to support your lifestyle at retirement. Using 2023 tax bracket and assuming a single person with no deductions, if you only have a tax deferred bracket, I'm talking about 401k and IRA, if all your retirement account is in a 401k, you will be forced to pull the full amount of $80,000 from your tax deferred account, causing you to be in a higher tax bracket. In that case, you will pay a federal tax of $12,907.50. Again, I'm using 2023 tax bracket here because I do not know what tax brackets is going to be in the future. Now, when you have tax-free accounts as part of your overall strategy, you could pull $40,000 from your tax-free account and then the other $40,000 from your tax-deferred account. When you go with this strategy, it will cost you to pay a federal tax of $4,580 using 2023 tax bracket, which means you will have more money in your pocket. So by diversifying your portfolio and considering these tax advantage options, you are taking steps to protect your hard-earned money from potential tax law changes in the future. The next thing to consider is liquidity. Have you ever stopped to ask yourself why there are restrictions when it comes to certain financial vehicles? I'm talking about the 401ks, the Roth IRAs, traditional IRAs, you name it. Well, financial vehicles are designed with specific purposes in mind, either for accumulation, meaning they build wealth over time, over the long term for retirement, or for liquidity, which means easy access to the money. Accumulation vehicles offer the potentials for growth and long-term financial security, but the money in these vehicles are designed to be kept until the future. They are not meant to be withdrawn whenever you feel like it, hence the restrictions. On the other hand, the liquidity options gives you easy access to funds when you need them. Think of checking accounts and traditional savings account. They provide the flexibility to quickly and easily access your money whenever you want, but they don't accumulate much cash through interest. Now, here's where life insurance is a little different. It's unique because it combines both accumulation and liquidity. It offers you the opportunity to build up cash value over time, just like those other accumulation focused vehicles. It also provides you the flexibility to access money, although it's not exactly the same as a checking account. So let's consider this scenario. Imagine that you're a business owner or involved in real estate. You know how important it is to have access to funds when great opportunities arise. You don't want to deal with the bureaucracies of a bank or risk missing out on a fantastic deal. That's where life insurance can come in handy. It offers you a secure place to store your cash and earn some growth while you wait for the perfect investment opportunity to come along. Then, once you find the opportunity, it offers you access to fund using your policy as a collateral. Now, it's important to know that not everybody places the same emphasis on liquidity. If your main financial strategy is stashing money away in an IRA or 401k for retirement, liquidity might not be a top priority. But for those who value flexibility and want easy access to funds when they need it, think of business owners and real estate investors, then life insurance can be a really attractive option. The next point is portfolio risk management. Financial advisors and planners are quite savvy when it comes to managing risk in investment portfolios. They understand the dangers of putting all your money into the unpredictable stock market. That's why they will often allocate portion of your funds to conservative instruments such as bonds. It's a way to balance out the risks. Interestingly, life insurance can play a similar role as a secure and conservative vehicle within your investment portfolio. It's not something that usually comes to mind for most people, but it's worth considering. Think about it. Many individuals have been profoundly affected by their experiences in the stock market. Take the 2008 market crash, for example. Those who suffered significant losses, up to 40% of their investments, are likely to put all their eggs in the stock market basket again. So by incorporating a portion of your assets into life insurance, you create a more balanced and appealing mix of vehicles in your portfolio. This is especially attractive to those who have a more conservative or moderate risk profile. A blended portfolio, which includes life insurance, offers you flexibility when it comes to accessing funds during retirement. It acts as a buffer against market volatility, giving you control and peace of mind. Now, what do I mean by that? So imagine you saved all your retirement funds in a 401k, and when you are close to retirement, the market takes a nosedive. In that situation, you might be forced to sell your stocks at lower prices just to access the money for daily living expenses. It's not an ideal situation, right? Now consider a blended portfolio. When the stock market is performing very well, you have the option to sell some of the stocks and use the proceeds as income. And during market crashes, you are not forced to sell at unfavorable prices. Instead, you could tap into the funds from your life insurance policy while you wait for the market to recover. It's all about striking a balance and diversifying your investments. By including life insurance in your portfolio, you create a safety net that allows you to survive market fluctuations and have more control over your financial future. But if you're an aggressive investor and you're looking for the highest rate of return, a conservative vehicle like life insurance might not meet your expectations. The next point is business planning. This factor is geared towards business owners. Now, imagine if a key person, someone who is critical in your business success, were to pass away or become disabled. It could have devastating consequences for your company, right? there could be loss of revenue, increased expenses, or even disruptions to your day-to-day operations. It's a scenario that no business wants to face, but it's also important to make sure you are prepared for. This is where a key person life insurance can help. The business can take out a policy on the key person, and in the event of their death or disability, the company receives a payout. The proceeds can then be used to provide financial protection for the business during the transition period, like recruiting and training a replacement. Part of the proceeds could also be used to help support the key person's family in a difficult time. This ensures that the business can keep operating smoothly and minimize any negative impact. It's like having a safety net in place ready to catch the business should something unexpected happen. But key person life insurance isn't just useful in the event of death or disability. It can be utilized when the key person retires. The policy's cash value can be used to fund an unqualified retirement plan for the employees, ensuring that they are secure and set up for a happy retirement. So, whether it's about protecting the business from the loss of a key person or ensuring a smooth transition during retirement, key person life insurance can be a valuable tool for businesses. As you can see, the reason to get life insurance will vary from person to person. Life insurance is about financial protection, tax diversification, liquidity, risk management, and business planning. Life insurance has very little to do with comparing its rate of return with the stock market. Don't buy life insurance because an agent promised you it will perform better than the stock market in the long run. The truth is that nobody has a clue how the market will play out. Instead, focus on assessing your specific needs based on the points we've discussed today. Consider whether life insurance addresses those needs and make a decision accordingly. So if you got any value out of this video, please click the like button and subscribe to my channel. You can also hit the notification bell for future videos. In the next video, we are going to look at some case study where we select different types of life insurance policies based on a person's needs. Now, if you are considering getting a policy or need a third party to review an illustration, give you a honest opinion, feel free to reach out to me. My contact is going to be in the description below. Thank you so much for your time, and I will see you again in the next video. Bye.